Welcome to Subramani. I just did a video, I just made a video which you would have already seen on interest rates and asset prices, how they are related in the short run. So, if you believe that interest rates and asset prices are connected in the long run, you are not wrong, but you may not be correct about how you think the relationship will be, right? You've always heard that when bond prices go up, equity markets will crash, and that's it's almost the end of the stock market. That's not true. We have seen interest rates go up in the US recently. I'll take more data from US and Canada also. When you saw that when interest rates went up, the equity prices fell. This is true in the short run. In the long run, the equity investor will have to be rewarded at a rate greater than the current interest rates, because otherwise there is no incentive at all for him to come into riskier assets, right? So for over a decade we have been saying, or maybe even 20 years we have been saying, interest rates are too low and therefore asset prices are high. Share markets are up because interest rates are low, and when interest rates go up, market prices will fall. And now with the failure of few of Credit Suisse and a lot of American banks, regional banks, we knew and know that interest rates will remain high for a reasonable period of time, not very long, but a reasonable period of time. It will go up and then it may take a little more time to come down than what every market pundit expects it to do, right? So in the meanwhile, yes, will stock prices fall? They should fall. Logically they should fall. Will it stay low for a longer period of time? The answer is no, it will not stay lower for a longer period of time. Why does this happen? Simply because when interest rates go up, your nominal return also goes up to compensate for the interest rate. So your businesses will increase in their value. They will do more business, they will earn more money, they will pay more dividend, and therefore people's expectation will also go up, right? People will expect more returns, and they will start getting higher returns. So when they start getting higher returns, they are willing to pay a higher price for the shares that they buy. So share prices will go up in the longer run when interest rates are high. Higher bond yields will bring down the asset prices or stock prices is a good thing in theory, because but it is making an assumption that the amount of money supply in the world is limited and all of us are competing just for that fund, right? So we believe that there is one pool which will look at the most efficient way of investing, and when the bond yields are better, it will be in bonds, and when the yields in equities are better, they will shift to equity, and therefore the price change happens. That is not totally true, because what happens is, first of all, there are different sets of funds, those who will put only in bonds and those who will put only in equity. So the base is not true, though largely it seems to be true, but yet there are different classes of people who will invest here and those who invest there. Secondly, the market looks forward. The market says, okay, now this is the yield, but the company is going to do well. See, when interest rates change, also businesses change. Some businesses will do well, some businesses will do badly. Now something like a consulting business is not connected at all with interest rates, so they will keep increasing their money supply in their hand, and that could get invested in equity or in debt. So if it gets invested in equity, obviously equity prices will go up, and if it gets invested more and more in bonds, interest yields will keep coming down, right? So there is if you are saying there is a limited supply of money and all the money goes into debt, obviously yields will come down here and asset prices will go up because there is nobody buying equities, right? Asset prices will remain constant or go down because nobody is buying equities, and at some stage equities will become more attractive than bonds and money will shift from here to there. That is what should happen logically. That is in theory, but in real life what happens is the business does well. The business does a lot of things. Some, like they say, it will wiggle and waggle, but there's obviously the businesses will do well. They start paying more dividends, and if the dividends are not attractive enough for the people and the share price remains low, they will do a buyback. So some way money will get pumped into the equity market, which will take the equity market higher. So when interest rates are higher, in the immediate term the share prices fall, but however the business income increases, the nominal income increases in the business, which is used to fund more business instead of borrowing money because interest rates are high. and therefore increase the EPS and therefore increase the dividend or increase the buyback. All these things will take the share price up, and there are enough examples for us to see. So to take a Canadian example, the Canadian treasury bond for 10 years gives a 3% yield, and the yield which is visible on the equity markets in Canada, which is again an energy dependent market, is minus 4.5%. People are expecting the price of the shares to fall because of energy prices falling, right? So that is bound to happen. Look at the gap that exists. So let me give you some more examples from the US, or look at the flat 2023 expectations that people have from the equity markets in the US. Even from India, I don't think 2023 and 2024 are going to be great, simply because of the political uncertainty. But when I bring political uncertainty to interest rate scenario, then it gets more difficult. But I don't see Indian markets running away. So the tendency is to believe because interest rates are higher, the market is not going to run away. The truth is no. The election is also holding back the Indian market. So Indian market is very difficult to say what will happen based just on interest rate. Based on interest rate, the equity market should go up. But giving 2024 elections, maybe April, May, I don't see any reason why the equity markets will go up unless the market feels more and more confident about a Modi comeback. What happens if Modi doesn't come back? So people will be wanting to keep a portion of their money for such uncertainties, which could be buying put options or keeping cash. Sorry, I am digressing. The spread between stock yields and dividend yields, right? Between stock yields and bond yields keeps widening. So I think the US 10-year gap used to be something like 2.23, if I am not wrong. Yeah, S&P earnings, and in the markets of 2000, the United States, the average gap between the 10-year treasury and S&P 500 earnings was 2.23%, which is not very far away from today's current 1.89%, right? I think currently it is 1.89%. But remember, in the last 10 years, the equity market in US grew by 120%. Right, so high interest rates will not stop a country from growing or the equity markets from growing. That is very important to realize, and there are very many reasons for that. During the 1980s and 90s, the US Treasury was always above 4%, right? That did not stop the equity market from booming. I think 1980s and 90s, the market went up by 400% and 433%. So high interest rate does not really mean that the stock markets can't go up. It just means the stock market will have to go up by a rate greater than the nominal return that the bonds are giving, adjusted for inflation. So it will have to be even assuming it's a 1%, 2% real rate, the equities will have to give you 4% kind of a real rate for you to be attracted towards it. Otherwise, more money will go into bonds. But this is again theory, because practically speaking, different pools invest differently, and now even in India, one sees that the bond yields are about 8%, but there are still, you have your Coal India and Indian Oil available at a dividend yield greater than 8%, maybe 9%, 10%. Caveat, I own both Coal India and Indian Oil, and I could be a trading position or an investing position, just clarifying. So when interest rates go up, do asset prices fall? Answer is yes. In the short run. In the long run, the market adjusts for the higher interest rates. So you will, because of the higher interest rates, there will be higher nominal rates, and therefore higher, of course there will be taxation and inflation to take into account. But after that also, if you get a positive return in a bank FD or a RBI bond, chances are you will get a much better return in the equity market. Also remember, when interest rates are high, normally means inflation is high, and therefore the Reserve Bank or Fed is holding the interest rate higher. So when interest rates keep going up, the bonds which you bought suddenly look less attractive, because you bought a 7% bond saying, wow, interest rates are very good, it has gone up from 6 to 7. But if the government increases the yield, if it goes to say 9%, government issues more bond, then the bond which you bought actually is losing value. So it's very difficult to choose to put in a long range bond at the short, at the just at the beginning. Suppose interest rates have gone from 6 to 6.25 and you go and lock in your money for 9 years or 10 years, it looks very attractive, saying wow, till last month it was 5.75, now I'm getting 6.25. But when it goes up from 6.25 to 7 to 8, 8.25, then you're wondering, then the bond that you bought with the 6.25% yield does not look very attractive anymore, because you still have 9 years to go, or maybe 9.5 years to go, and you're stuck at 6.25, whereas the interest rate now is 8.25 in an RBI bond. So what happens is this 2% will have to be paid for, right? So this kind of a loss happens. So what happens in case of shares or equity is they pass on the burden of higher interest rate to their customers. Most of them are able to pass on if they're doing well. So therefore the earnings improves, and therefore people say, wow, these earnings have improved, and anyway I do not know how long to lock in my my funds, so I'll buy more equity. So more equity buying happens and equity prices go up, right? So please understand this relationship. It's very complicated. In the short run, interest rates rule the market. In the long run, the market learns to factor in the higher cost. So during, whether it is US, whether it is India, you see during periods of high inflation, interest rates are high, but that is the time when market also grows, because most of the good quality companies are able to pass on that higher interest rate to their customer and keep improving their margins. So that is the reason why in the long run the higher interest rate may get built in, and therefore it will not create this when the relationship in the long run between interest rates and stocks is stock prices go up when interest rates are inflated. You can take examples from India or US. It's always been true. Thank you.